All right, you guys, we're going to get started today. Thank you so much for joining me today. I'm Colleen Wood with the Wood team at Hometown Lenders. And today we're going to be talking about construction financing, in-house construction financing. I'm going to go ahead and show my screen here. All righty, you guys. So again, I'm Colleen Wood with the Wood team over at Hometown Lenders, and we are really excited about construction financing because, as everyone knows, there is nowhere near enough inventory in our country to be able to support all the demand of all the families that are needing housing. Our country as a whole is very, very behind in building, which is so surprising. A lot of people ask me about whether or not there's going to be another housing debacle. And the answer is absolutely not. And the reason is because if you remember back in 2006 and 7 and 2008, that was the highest level of new construction building across the country. And those builders and contractors were working so hard that they were able to create a surplus of inventory. Then several other economic factors happened. We saw a lot of layoffs. We saw the supply of homes being, because they were so high, we saw the values of homes going down. That combined with layoffs and some issues with some loans that people were not able to stay on top of their loans because of the layoffs that were happening. We saw a tremendous drop in values of homes. And so that's just a real simple supply and demand issue. When you have a surplus of supply, the value will go down because there's less demand for each individual unit. Well, right now, that is the absolute opposite. Prices are high right now on real estate because there's nowhere near enough inventory to satisfy all of the need. And that is a huge problem. So what we are seeing people doing a lot is, hey, instead of waiting for a home to come available for me, I want to build my dream home. I want to build the home that satisfies my family's needs. And this is something that has been a request of our clients for years. And it's been something that has been really frustrating for me because we've had to hand off so many construction loans to local banks because it was not something that we could handle in-house. We would end up doing the refinance of the construction loan into the permanent loan, but we weren't doing the construction loan. And the reason for that, there were several reasons for it. The biggest reason is you have to have somebody who's going to be able to manage it. It is a construction loan. It takes a lot of steps. There's a lot of people that are involved in it. Contractors get paid out throughout the process. So you need somebody that's able to manage all of that. The other part is inspections. The house has to be inspected as things go on. The bank wants to be able to see that the home is taking shape, that progress is being made, that the home that we've discussed is the one that's being built. So inspections are really important. And before, we didn't have a way to do that. And in fact, you'll see local banks not want to do construction loans in areas that they can't easily travel to inspect. And so that's been a limitation, especially for my folks that want to live in a more rural area. The banks just did not have the ability to come and do the inspections. Well, we have solved that problem with a company called Land Gorilla. And just very topical explanation of it. Land Gorilla is a company that they have an army of inspectors, and they are all over the country, and their job is to come and inspect construction. And so with that tool, we have been able to put together an in-house construction loan product for you. So I'm really, really excited to present this. I've been talking a lot about this with a lot of people, and I thought, let's get this information in front of you guys as soon as possible. So we're going to dive right in here. New construction financing, new builds. So there's a big process that goes into building a home. It's not a short process. This is definitely one that needs to take form with the assistance of a lot of professionals and a lot of thought process. So number one, anytime you're looking to do any sort of financing, it is a really good idea to encourage your clients to get pre-qualified. And they reach out to me, and I'm not only going to pre-qualify them for the construction loan, I'm also going to pre-qualify them for the takeout, is what it's called, which is the permanent loan that will be done at the end of the build. So they're actually going to have two files with me. And when they're getting pre-qualified and then they're building, they're going to need to maintain that pre-qualification with me. So if they're building for a year, we're going to want to see them have very metronome, very similar employment, very similar hours worked if they're an hourly employee. We want to make sure that they're not going out and getting a whole lot of debt. This is a very extended approval time. And so it's really important that everybody's in the boat and rowing it in the right direction. The next step is that they're going to need to find a contractor, find a builder that's going to help them design and set up a timeline for what we can do when it comes to building. This process can take a long time. They might end up working with an architect and then a builder and then picking finishes. This takes quite a bit of time, but you do need to design a plan and come up with a bid for how much that's actually going to cost. And that's wells and power and site prep and everything that's going to go into this project. Is there landscaping? All of those decisions need to be made, and they need to then be bid out by the contractor so that we can start determining what is our cost of construction. So once all of that is set up and decided on, then we go ahead and move towards our initial closing. So this is going to be a two-close construction product, meaning that there's going to be two separate loans with two separate closings. So the first loan is going to be our construction loan, and then the second is going to be our permanent loan. So we can actually even wrap into the first loan, the construction loan, the cost of purchasing the land. So as they're designing, they're also looking for a piece of land, or maybe they even have one already bought. But as a first step of a construction loan, if it's necessary, we can have that first draw be the payment for a purchase of a piece of property. So all of that can get wrapped in together. Once we've done our closing on our construction loan, we are good to start building. And the builder has 12 months to build. We'll talk a little bit more about that as we progress, but they start to build. So all of that process is going to happen. We're going to get into a little bit more detail here. And then at the very end, when everything's getting wrapped up, we're going to look at refinancing into our permanent loan. So again, there are two phases to a construction project. Number one is the construction phase. This is the time allowed for building the home. During this phase, the borrower will make interest-only payments. So they're only going to pay interest on the amount that they've drawn. So if they've only drawn out, say, $50,000, they're only going to be required to pay interest only on that $50,000. So trying to keep everything affordable, pretty common for construction loans to be interest only, and then again to only be on that amount that they have drawn. And so as they're building, that amount that they've drawn is going to continue to get higher. So we're expecting that the payment's going to get a little bit higher and a little bit higher and a little bit higher as we're building. Again, there is a maximum of 12 months that are allowed for building time frame. The permanent phase. This is when the construction of the property has been completed and the construction loan is then refinanced into a full term loan. Your usual loan products that you usually see, easy peasy, little refinance, pays off the construction loan, and they're set up with their permanent loan. That's principal and interest like you would normally have. Eligible borrowers. This is really exciting because there's a lot of borrowers who are going to be eligible for this. The program guidelines are really allowing for a lot of people to take part in this. So we are going to be reviewing everything that we normally would. credit, income stability. Do they have money? Do they have any reserves, anything like that? A lot of eligible borrowers will already hold title to a piece of property, or they'll be able to purchase that property as the first part of their construction loan. There is a minimum down payment of 15%, and that's 1-5. I'm really, really excited about this because, as you know, a lot of construction loans at local banks sometimes require like 30% down. It's a lot. And so I'm really, really grateful to be able to offer 15% down. And that is a 15% of the entire project. Now, something that's really exciting about this is, say you have a piece of property that somebody has already purchased and it's free and clear. We'll say that it's worth $150,000. That $150,000 of equity is going to be allowed to be applied towards that down payment. That's super, super exciting. We're going to be able to use the equity from that land towards our down payment, and that might take up all of the down payment. Who knows? It just depends. So they're going to be able to do that and be able to use any equity that they have. So 15% of the down payment or of the entire project is our down payment. Minimum credit score, 680. That's really exciting. Doesn't have to have a super high credit score. That's also something that's an improvement off of what you see from a lot of local banks. We can use this product for primary residence or second homes, single family, no manufactured homes. We do modular homes. So you have to know the difference between manufactured and modular. We don't do manufactured homes, but we certainly do double wide modulars, no condos. And this is going to be a 1-unit property. Another factor that's really important is our maximum loan amount is going to be $726,200. So no jumbo loans on this particular product. So our product and credit overview. So this is an overview of the loan product. So when we are all done with construction, we are going to be able to refinance them into several different types of loans. A conventional loan, FHA loan, VA loan, rural development loan, and several different terms. So 15, 20, 25-year, 30-year terms. So there'll be a lot of options. There's not just a canned answer for what they're going to be able to refinance into. If it makes sense to go into a different product, then that's what we're going to do. So we have a maximum loan to value of 85%. So again, 15% down payment, minimum credit score again, 680, and the maximum debt to income ratio is going to be 43%. It's a little bit of a conservative debt to income ratio. We're not seeing it maxed out at that 55% that sometimes we see with FHA. This is going to be, anytime you have construction, we're going to be a little bit more conservative. Because things can change. Things can change, and you're going to want to be a little bit more conservative when it comes to a long-term product that has to maintain approval for a very long time. If that debt to income ratio pops up to 45%, we do just need to have 6 months worth of reserves for the buyer in order to just kind of protect everything. The construction term, you're allowed to build for up to 12 months, no greater than that. The project has to be done in 12 months. Our old construction products, we would see construction last for years. And I think you can agree that paying interest only for years and making no headway on your principal is not a really great plan. So we do set a 12-month restriction on that construction phase. The interest rate on the construction loan. The interest rate on the construction loan is attached to the prime mortgage or the prime rate that is set by the Fed. So the prime rate currently right now is at 8.25. What we see a lot of banks do is that as the prime rate adjusts, they will also adjust the construction rate. We don't do that. Once we set the construction interest rate, it's going to stay fixed for the entire period of construction. So whatever that number is for your interest rate, and we're going to talk about that here in a minute, it's going to stay the same through the entire project. So no rate hikes that are 6 months in that a client needs to deal with. Again, it's going to be an interest-only payment on the construction. During the entire construction phase is going to be interest only. Now, something that's really exciting is that we do allow for tear downs. So say you bought a piece of property and there's an old, ugly manufactured home from 1970 on the property. We can actually do the tear down and factor that cost into your construction. So if there's an old barn on it, or if there's an old house that you don't want to keep, maybe you want to build on top of it, we can definitely help with that. The permanent loan will be structured as a rate and term refinance, and that will be what we do at the tail end of the construction. So everybody asks this question: what are your rates during construction? And this is going to be very cut and dry. I really, really like this setup. So rates are based on prime. Prime is the rate that the Fed adjusts. When you hear about the Fed increasing rates, that's the rate that they've been playing with. So the prime, it's going to be prime plus a margin. The margin is going to be dependent on the credit score. Just the credit score, not anything else. We like to make it simple. Currently, prime is sitting at 8.25. So if your credit score is between 680 and 699, it's going to be 8.25% plus 3%. And that's going to be your interest rate during your construction phase. If you are a credit score between 700 and 719, it's going to be prime plus 2%. But all the way down to 720, which is going to be our lowest interest rate. I just love that our range starts at 720 to get the best interest rate. It's going to be prime plus 1.5%. So that's really exciting. And then you guys, when we see prime coming down, you're going to see that interest rate improve for new construction products. Again, it's only an interest-only payment during your construction phase. So the builder has to be accepted to be a part of this project. We don't want a brand new builder who has never built a house and he's going to try it out on us and our buyer. That's not going to work for us. We're going to need to review the builder and make sure that they have a good quality business, that they have a history of being able to put up houses like this. We're going to want to see that, again, that they have a history of building houses like this at least 3 years. They've built at least 3 similar type homes of a similar size, acquisition costs in the same state in a year. So we want to be working with contractors, not people that just do handyman stuff on the side. The builder or the retailer of a modular home has to act as the general contractor or a construction coordinator. So they are responsible for hiring any subcontractors, for doing any of the site improvements. They have to make it so that the buyer, when we're done with the construction phase, can move into the home. This is a really, really important thing, and I get asked about this all the time. It used to be we would allow for builder or for buyers to swing their own hammer, in that whatever they were capable of doing, whether they would be able to build the whole house, or maybe they're a drywaller, or maybe they, can do electrical, they know how to, they know how to paint, something like that. Construction products anymore do not allow for self-help. A buyer cannot go in and do their own construction. There's so many reasons as to why that's not a good risk for an investor or for a buyer. I remember before this rule went into place, there was a construction loan that we were responsible for, and the construction took over 5 years, you guys. And the reason why was because the buyer was also the builder. And he had a full-time job that he was a teacher. So he needed to teach all day, and then he was building on the weekends and at night. And that just took too long. It just took too long, and the risk was huge, and this just doesn't make sense. So no self-help. They can't be responsible for hiring any subcontractors to perform such work. They have to allow a contractor to come in and build them a home. No related parties. So we're not going to get all in cahoots with people, do any good buddy discount stuff. And this has to be a real job site with people that are involved, that are really do this work. No good buddy discounts, no issues with identity of interest between the borrower, the builder or retailer, a realtor, a lender, myself, a contractor, a consultant, or an appraiser. So no good buddy things. It has to be done fair and square. It has to be done right. Has to have an arm's length transaction between all parties, meaning that we can't be related and married to each other and all of that. The borrower cannot have any ownership of record in the builder's company. So the borrower cannot have his own company come in and build him a home. It's a huge conflict of interest. The builder has to have a already established supply credits, be able to access supplies on credit. We're not going to just start out brand new, fresh with that. I see my notes are behind. They have to have a contractor's license and proper insurance of $1 million to be able to protect everyone during the process of doing the construction. The other thing is that we are going to look at the builder's credit report. We want to make sure that this person does not have a history of bankruptcies, foreclosures, like that they're not a good credit risk, because we're really leaning on that contractor to do what he says he's going to do. So we want to make sure that this is going to be a good person to work with. The draw process. Everybody wants to know about the draw process. So if the builder is approved, we can allow them to take a 3% initial draw right at the beginning, right at the initial closing. The draw breakdown from the builder disclosing material and labor expenses to cover the total draw disbursement. Initial draw requests over 3% will be required to provide additional documentation with a maximum of 10%. So that's a question that comes up all the time is, hey, I need money to get started and buy materials. We can make that happen, but we have to have the documentation to show what it is that we're paying for. We allow, our draws will be paid out within 5 business days. And a lot of times it's happening a lot faster than that. That's one of the biggest comments that we get from builders is you guys are so fast to pay. We do direct deposits. So we like to just make things as fast as possible. After we've done a little quick review of what's been going on, then when a draw is submitted, we're getting it paid out as soon as possible. So the inspection, making sure the borrowers are still employed is something that we do before we pay out a draw, update title, and then we disperse the funds. So again, disbursements will be made by wire transfer directly to the builder's bank. So that's really exciting. So no waiting on snail mail. We like to make things as efficient as possible in order for that to happen. There'll be a minimum, there'll be 5 inspections and draws available to the borrower during construction of their home. Any additional inspections will have, or draw requests will have an additional fee that goes along with that. All right. Okay, talking about our team. So you guys are familiar with our team. Everything that we do, I have an all-female team. Very, very, very proud of that, but we kill it in the real estate side. But part of the hang up with a construction loan was having someone who was able to manage the construction piece. There's a lot of hands-on work that goes on for a year in order to do a build. So the draws, the ordering of the inspections, the title updates, the verbal verification of employment to make sure everybody's still employed is a lot of work. And so it was really important that we had a team member that was all that they do. So we have a phenomenal lady. Her name is Joanne, and her job is nothing but construction loans. That is all that she does. She's amazing at it. She's been in the business since 1986. So a very, very long time. She loves visiting with people on the phone. She loves talking to the builders to communicate what it is that they're needing. She's just a very high communication type person. And she's really, really good at her job. So we're really happy to have Joanne on our team, helping us with all things construction. So really excited about that. And then I just wanted to say, Thank you so much. Thank you so much for jumping on and listening about our construction products. We're so proud to be able to offer this. This has been years in the making. So I'm really excited to be able to have developed this, excited to work with you and your clients on their construction projects. So let us help. If you have questions, you want to bounce ideas off of me, that's what I'm here for. Give me a call. Let's just talk about whatever situation you have going on, and let's see if there's something that we can do together. Everybody that has jumped on for this webinar will be receiving our construction loan flyer via email, so I'll be sending that out. But if you have any questions about anything pertaining to construction or anything residential mortgage financing, I'm your gal. Give me a call, 406-220-0077. And I'm so grateful you spent some time with us today. I hope you have a great rest of your day. Bye-bye.